Ticker symbol CALM is up over 60% in the past year, and today we'll be looking at a company with a high dividend yield with large economies of scale. However, this company's financials are highly cyclical, but in the past year its net income has risen by over 125%. And adding on to that, they have had an incredible net margin expansion in the past 4 quarters. So today we'll be looking at none other than Cal-Maine Foods, an egg and egg product provider. In their annual report, they state that they aim to be the most sustainable producer and reliable supplier of consistent, high-quality, fresh shell eggs and egg products in the country. They're a company that is basically vertically integrated into providing eggs. What does this mean? Well, it means that their operations consist of hatching, growing, and maintaining flocks of layers and breeders, manufacturing even the feed for these chickens, and distributing the shell eggs. I found this very interesting, but they divide their chickens into layers, which are the ones that lay the eggs, and then breeders, which are just there to ensure that they will continue to have a sustainable and large flock of chickens for the long term. One good thing is that this company can meet the evolving needs of customers with conventional and also specialty eggs. So for example, they were analyzing the wants and they saw that there was a niche for cage-free, free-range and pasture-raised eggs, as well as other egg products that, although were not their key offering, they decided to go for them as it could be a growth opportunity, and so far it has played out very well. My one worry for this company is that they don't necessarily set the price for eggs. They use cost-based pricing accounting in order to set the prices. However, this means that their prices can be extremely volatile, as there are a lot of factors that will play into this and even rise or lower their cost, which will in return increase and lower the cost of their eggs for their different suppliers. So for example, their main expense comes from their feed, and it's a product that they actually manufacture themselves to actually feed and control their chickens. Well, when the raw materials such as corn and even soybean meal, which is used to create this feed, when their costs actually rise, for example in the past couple of years when commodities have risen constantly, well this means that they will have to increase their prices to producers in order to maintain their margin. But now on another topic, according to the USDA, around 81% of shell eggs were sold through food-at-home outlets, which is basically through retails and shops such as Walmart. 16% were sold to food-away-from-home channels, which basically implies restaurants and other businesses. And only 3% of these eggs were exported, and mainly to closed markets such as Mexico and Canada. But in the specific case for Cal-Maine, their main revenue source actually comes from private label conventional eggs, and through branded specialty eggs, which have higher price points, so that's a benefit for them. And who could know that an egg provider could have such amazing financials? They currently have a 50% return on capital employed, which, just for you to put these numbers into context, we usually look for companies with a return on capital employed above a 15%. Next, they have an over 100 times interest coverage ratio, meaning that they won't have to worry about debt anytime soon, and they have an 87% cash conversion ratio, following up with a 40% gross margin and a 26% net margin, again over our 15% threshold. And when we look at their financial evolution, we can see that cyclicality that we were talking about. It looks like their margins are extremely correlated with their revenue growth, as whenever their revenue actually declines, both their margins actually follow. And this makes sense, as we stated previously that they follow a cost-based pricing method, which allows them to increase their margins when revenues are higher, as it allows them to distribute their fixed costs along more products sold. But taking this into account is key, as this cyclicality can actually be caused by, for example, a bad season for egg layers, international demand, international supply and demand, and just general consumption patterns. But what is great to see is that their efficiency ratios are a lot more stable, and these have been rising constantly, with return on invested capital, which is the one that we usually like to look at, sitting just under 35%. And the great thing to see is that their balance sheet is amazing. They have a current ratio of over 5 times, meaning that they could pay only by using their total assets all their total liabilities over 5 times. And the great thing that we can see here is that although their liabilities have been increasing, their assets have been increasing at a much faster pace. Now, when we look at their fundamental analysis, this company gets a 5 out of 8 ticks, starting with the fact that they have a low liability risk from the over 100 times interest coverage ratio that we saw. They have a very solid balance sheet as they can pay all of their short-term liabilities only by using their current assets. They pay a dividend, which is not very consistent and has a very high yield, and they have had organic revenue growth for the past year. Now moving on to the two most important factors from this slide, which is their pricing power and their existing moat or competitive advantage. We usually define pricing power as being able to raise your prices at a rate above inflation for a long time without losing too many clients. And in the case of Cal-Maine, I don't believe that they actually have this ability. They actually use a cost-based pricing method, meaning that whatever their cost is to make one egg, they will sum, for example, a 10% margin on top of that and sell the eggs at that price. This means that yes, they do have the ability to pass through inflation and rising costs to their clients, which is an extremely useful ability to have. However, they're lacking the ability of actually increasing and expanding their margins by increasing prices at a way faster rate than the rate of inflation. And of course, this is expected because Cal-Maine is actually selling something that is considered a commodity, which is egg and egg products. One thing that I believe is interesting for us to keep in mind is that right now that they're actually offering a wider range of specialty egg products or higher value-added products, these usually do have a component of having higher margins and being able to raise their prices at a rate above inflation, as there is a lot more work done to those products than only having chickens that lay the eggs. So as long as their demand keeps increasing for these higher value-added products, I believe that they could actually be leveraging this pricing power. On the other hand, when it comes to existing moat or competitive advantage, I don't believe that there is a larger egg producer in the United States. And this is key because it allows them to have massive economies of scale, which in this industry is extremely relevant, as they're able to negotiate with their providers for the raw materials they use in the feed and for just buying chicken flocks in general. Additionally, by being the larger distributor in the US and having farms all around the country, they're able to negotiate with some of the largest clients such as Walmart or even Costco and have agreements with them ensuring that they will be able to satisfy their demand wherever and whenever it's needed. And this gives those large clients a very good security that they will be able to keep providing these products. On the other hand, there are a couple of things that I did not quite like about their fundamental analysis, starting with the fact that their cash flows are actually not consistent and they're not growing. This could be because of an increase in capex and higher investments into new locations or into maintaining their existing ones, but this is something that I don't actually enjoy seeing in companies that I would potentially invest in. And the other one is that they're actually not buying back shares, and in fact the numbers of shares outstanding is actually increasing. When we look at their dividend, we can see that they currently have an enormous 7.21% dividend yield, only at a 33% payout ratio. What this suggests is that they have enough free cash flow to pay this dividend over 3 times, meaning that they have room to run for increasing dividend yields, to sustain this dividend, or to even start considering share buyback programs. However, from what I have seen with their fundamentals, they are extremely cyclical, and this means that this 7.21% dividend yield has been calculated with the 12 trailing month free cash flow that the company has generated. However, what is stopping the company from having terrible free cash flow in the following 4 quarters? So if I were an investor, I would ignore this 7% because I don't think it's realistic, and as we have seen, they have a history of decreasing and increasing their dividends whenever they can. I wouldn't call this dividend safe or sustainable. And the same goes on when we look at their valuation analysis. Yes, they're currently trading at a price to earnings ratio of only 10 times, but their earnings have been unusually high this time of the year. They're currently trading at a price to earnings ratio which is around the average where they have been trading at for the past 4 years, but when we look at their free cash flow yield, they're currently yielding a 17.2%, which is a lot higher than the long-term inflation rate. And although this suggests that this stock may be extremely undervalued, we do have to keep in mind that they have had record free cash flows, and I have not seen an indicator that this free cash flow generation levels are sustainable. So this could actually be very deceiving for investors. And when we look at the risks and possible challenges, the main one that I see is the not meeting performance objectives, especially because we have seen that the financials for this company are extremely cyclical, and that means that there is a high chance for them to actually have very bad quarters in the following couple of years. And considering how high their stock price has actually risen in the past year, and how high all of their free cash flow and financials have actually gotten, there is a high chance for a big price drop in the near future if they don't manage to actually make those financials sustainable in the short term. And when it comes to the economic downturn or cyclicality risks, I believe the risk is minor because eggs are considered a commodity and everyone will try to buy eggs regardless of how hard the financial situation is. Now, before we move on, please remember that I'm not a financial advisor and this is not financial advice, so please do your own due diligence. However, I believe that this company has a very strong competitive advantage and they have very high return on capital employed, which means that they know how to create value for the investor. However, they don't generate consistent cash flows and they're highly unpredictable and cyclical. So although I believe this is a good company, I'm unsure whether this would be a good investment, especially because they're facing limited growth and the sector is not the best for investing in. And having said that, thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content and I'll see you in the next one.